that you'd want to see it?
It was just a suggestion. I think we should record this because Angela.
In other words, I'm trying to drill down here so that everyone, including myself, right, has a step-by-step. Here's how to determine that you just went in the particular item. You went bearish trade. That's easy. Bearish trend. That's a little bit more difficult process to weed out. And that's what I wanted to focus on. Because that's where I've been like, okay, I woke up yesterday morning. I swear to God, this is what I was thinking about when I woke up yesterday morning. I couldn't get my arms around how do I figure out that a particular factor exposure has gone bearish trend. Trade to me is 3 weeks or less. Trend to me is 3 months or more.
All right. Well,
I think you need to get a golf game on the weekend, by the way. It's like thinking about that stuff on the weekend. I'm joking.
One, the first thing is to use the matrix numbers as technical pivots, and they're closing numbers. You can't lose sight of that.
Okay.
Two, you have to respect the targets. So now here, we're up the third time now in the NASDAQ at the target at 14K. The first time we went up to 13.9, broke 1,400 points. Came all the way back up, made a higher high, broke almost all the way back to the quarterly pivot, and rallied all the way back up again. Right? So, but the spreads have never turned really down. So even during that whole downturn, it never confirmed a bear market. All it did was say that it was a corrective phase. Because here, even if you look at the NASDAQ bonds off that high, it never gave you, it didn't give you an ORL here. It gave you one here for a short-term trade down to the cloud. That was a 2-day trade and it bounced again.
What you would have needed to have seen there was a continuation, into the cloud?
Throughout the bottom of the cloud, and I would have needed a failed rally on Thursday and then started down again. So you needed a midweek high in the indices, not a midweek low. So if the model's going to turn, you need a midweek high, not a midweek low.
Okay, so let's see if we can frame this out. Violation of the quarterly pivot, an ORL on the bond spread, a failed rally off of a midweek high. Did I get that right?
Yeah.
And then turning down again.
Right.
And
you
violating
need to see
the
right.
And then what do you want to see on the failure? A violation of the previous low?
Yeah, and you want to see this happen 2 weeks in a row.
Okay.
Now,
does everybody get what I'm driving at here?
Now, a year ago, we got one where it went 2 weeks. We got it 3 weeks, right? And I got a signal to go neutral, and we went straight up. Straight up. So I think it was, I don't know, it was sometime last year sometime. And then I just turned the models back up because, I got a bad, you can get bad signals, okay? Whereas, I got 2 weeks of what I was looking for from the market to go from up to neutral. And then, it basically in the third and fourth week negated that whole thing and just started up. You have to be flexible enough to realize that it's turning back up again and not wait the extra 2 weeks. And that's part of the art of trading. And that's part of, the Fed breaking the bond market.
Yeah. And you see, Judd, for me too, I'd like to consider myself a long-term investor, right? That rebalances daily. So a practical part of my risk management is to always sell some when you hit certain targets or certain levels, right? So that if that starts a correction, my risk management already had me taking some off. And then it allows you a little bit more time to stay in the trade, right? I guess at that point, if you then go below, so you're selling some at a target, then you start to get a correction, you violate the quarterly pivot. That's a sell some more right out of the gate.
Right.
Okay. Then the correction continues, and you get an opportunity if the models or the signal doesn't turn bearish trend, you get an opportunity to buy back the stuff that you sold and ride it back higher, which is exactly what the Russell just did over the past week.
Yeah. And you need to trade level to level, matrix to matrix, and pay attention to it. And trade and look, well, you want to look at the spreads, but you also want to look at, each market holistically.
Yeah, because what I was confusing myself with yesterday morning, Judd, was how do I figure out that we've gone from bearish trade to bearish trend? That was the piece that I was having trouble getting my arms around.
Yeah, and so I don't think we change trend until, if we do change trend, until July. Typically the turns are the first of the quarters.
I hope everybody found this little exercise interesting. Hey, Andrew, do you think of it the same way? If you've been listening?
I was listening up to the last bit. Yes. Yeah, certainly a lot of the stuff that Judd does come from the same place.
Yeah, it's Howard 101. He gets it.
Yeah, exactly.
Okay. Yeah, because the easiest part about this is figuring out bearish trade. That's the easy part.
But it's just the crucial thing.
Bearish trend is takes a little more practice.
Yeah. There's different ways to trade, and obviously, the most important part of trading is the execution. It's the location. You can get a lot of things wrong, but if you execute right from the right location, you'll survive in this game. But if you don't execute
that
right,
is true.
And if you don't execute right, you're just not getting your location right, you can be right and still be horribly wrong, which is a feature of what you probably saw with gold last week. So
yeah, and if you recall last week, I was looking to buy them down in here.
Yeah.
And it rallied first. I never got filled. It rallied first.
Yeah, that's a great point as well. You got to be willing to miss things.
So Judd, you know what? Let's use gold now. Okay. Let's go to the window of time where you saw gold go bullish trend. I don't know if we're there yet. I think gold is bullish trade. I'm not sure if it's bullish trend yet.
Well, that was weeks ago when Andrew, like that 1865, or where the hell was it?
1675. No, well, I mean, it depends how you want to use it, right? I mean, look, moving averages are just a one measure. I use some pretty basic stuff there. I mean, again, I can show you the gold yen chart, and I think I know where that thing's going, and it's a friggin' lot higher. A lot higher. Now that's not going to help anyone in this room today, tomorrow, next month, or next 6 months. If you go through the chart, you'll just get enamored by the chart, and you become sort of very myopic around it, and it doesn't help you trading at all. Because time frame is the other feature of trading that you've got to get right. You've got to get your time frame right. There's no point listening to me. I mean, you look, the principles of trading are very much the same, but the time frames are different, and it looks a bit of a different horizon, and it's a lot more longer term. I have a longer term book, but certainly the execution, the sort of bottom up, if you like, the technical side, it pretty much there's a one-on-one way of doing it. Be careful trying to draw trend lines because very few people do them well. But the execution, the time frame are important. I mean, for example, gold, I've got gold long on every moving average I'm looking at. So I would say it's trend through 1 month to 3 months. I mean,
Yeah, I mean, this is, you had everybody rinsed out of the gold the first of the month, and it looked, from all the stuff Thursday that it was going to follow through on a Friday. It did follow through, and then it just completely rolled back over again. So, that's part of just trading the price action. And now they're going to now in the S&Ps here on the daily continuation, they're going to go get the stops at 30.75 just to drill everybody.
All right, that was a good exercise, Judd. Thanks.
Okay.
All right, stop recording.